So good morning, everybody. Good morning, Aradhi, Sri Lakshmi, Susan, Farzana. Morning, others. Can we start? Yes. So yesterday we were discussing about statement of P and L, isn't it? So let's recap. Aradhi. So we'll recap. Yesterday we were discussing about the statement of we understood that statement of P and L has got two parts. What are the two parts? Profit or loss, which starts with revenue, isn't it? And this will end with PAT, profit after tax. That means our normal P and L account. This is our normal P and L account. Okay. The second part is what? Other. Okay. Why there is other comprehensive income? It is due to more emphasis which is given for fair value. The assets and liabilities, if it is shown at fair value, there could be some fair value change, initial recognition. Subsequently, when there is a change in the value, when the assets and liabilities are increased or decreased, there is a corresponding impact. Some impact will go to P and L, fair value through P and L. But some other impact will be reflected in other comprehensive income. Now, other comprehensive income is being subdivided into two categories. What are the two categories? Items that can be classifiable. When I say reclassifiable means whatever is there in OCI, subsequently at some later stage, it will go to the first room. Now it is there in second room, but at some time, whenever it is realized from the second room, it will go to first room. Is that okay? And there are some items that cannot be reclassifiable. Okay. Yesterday we took an example of an item that cannot be reclassifiable, that is revaluation. Now, which standard says all this? Because this is given in Ind AS 16, property, plant and equipment. Ind AS. What do you mean by non-reclassifiable? Sir, revaluation, at the time of revaluation, it is just a anticipated gain, isn't it? Unrealized gain. It is not a gain that is actually realized. So they say that, okay, you want to bring your asset to fair value, you do that, but don't take that gain to P and L. Show it in a separate statement. Okay. Now, subsequently, when the asset is sold, whatever is unrealized will become realized on a later stage. When that happens, don't bring whatever is revaluation, don't take it subsequently to PAT. So, what will happen in SOCI? You already had revaluation surplus, isn't it? Say 3 lakh. From this, take this 3 lakh out and take it to your retained earnings or your P and L. Add it to. Now it is being taken to retained earnings, but it is not routed through P and L. Are you able to get? I brought this item to P and L. Now I can say that yesterday I got a message saying that, sir, at the end of the day, this is being taken to retained earnings, isn't it? If it is being taken to retained earnings at the end of the day, now this is distributable. Now this becomes distributable. Am I right? I say whenever it was in OCI, at the time whenever it was in OCI, it was not distributable. Subsequently, whether you reclassify to P&L and bring it to retained earnings, or you just take it from OCI and take it to retained earnings in SOCI, which is not reclassifiable, at the end of the day, maybe after third year, it is distributable only. So there is no doubt about it. I'm not saying that once it becomes revaluation surplus and subsequently reclassified or non reclassified, it never becomes undistributable. I'm not saying such that. I said whenever it was in OCI, it was not undistributable. It was not distributable. You couldn't pay dividend out of it. But subsequently at the third year, in my example, on third year, the land was sold. Okay. So third year when the land was sold, it becomes distributable. It is taken to retained earnings, which is free reserves. Retained earnings is what? Free reserves. There is no restriction attached to this free reserve. It is available for distribution of dividend. It is available for distribution of dividend. Is that point clear? So that way, we have taken that example. Next thing that I said is, actually we were discussing the second point, that is the concept of fair value. Concept of actually there is a standard itself, that is Ind AS 113, that deals with what do you mean by fair value? What do you mean by fair value? It is not a accounting standard, just say defining what is fair value. How do you determine fair value? Is that okay? But the term fair value has been coming. The term fair value is there in different standards. Like one example that we said was, say, Ind AS 16 says that at balance sheet date, not at initial recognition, because the initial recognition PPE will be recognized always at cost, always at cost. If I buy a car, I'll have to recognize the car at cost only. I cannot bring it at fair value. But on balance sheet date, I can either show at cost, that means depreciated value, or I can show at my fair value. Whatever fair value gain, the fair value gain or loss, there is a separate discussion on how, if there, now I've taken an example of asset value increasing, it will go to revaluation reserve. Assume tomorrow if the asset value comes down, then it will go to P&L. The fair value reduction will go to P&L. All those discussion we will be doing subsequently when we come to what? Ind AS 16. So for the time being, assume that there is an increase in value of asset. There is an increase in value of asset. Clear? Similarly, there is Ind AS 38 that deals with intangible asset. Intangible, similar to tangible asset only. One is a tangible asset. PP is what? Tangible asset. PP is what? Tangible. So there also it is almost same, cost followed by cost or fair value. We also discussed that this PPE also includes bearer plans. What? The other biological assets like livestock and other than bearer plans, other than bearer plans. We said it is governed by Ind AS 41, agriculture. Now, in this standard, the term fair value is there. They say that biological assets will have to be recognized, initial recognition as well as balance sheet date. It has to be recognized at fair value minus cost to sell. Fair value minus cost to sell. There is no concept of what? Initial cost. Is that okay? Like in financial instruments, we have financial assets. We have financial. See, financial assets can be classified into two types, three categories. One is fair value through P&L, fair value through OCI, and amortized cost category. Initial recognition in all the three, it will be at fair value. Balance sheet date, it will be at fair value. Here also it will be at fair value. Here will be at amortized cost. That means with the help of, in our context, we can say with the help of the table. Whatever is the closing value in the table, using effective interest rate. Using effective interest rate. Clear? Now, sir, what happens to the fair value difference? Sir, initially it was 100. Now it is 120. So the difference will go to, you tell me, the difference will go to P and L. The first category it will go to P and L. Second category difference will go to OCI. Here I have given two examples. Here OCI I have given two examples. One is investment in equity shares. The one is investment in debentures. Where equity shares are classified through OCI, it is non-reclassifiable. It is non-reclassifiable. There was another term also that I taught. What was the other term? It is a irrevocable choice. Irrevocable choice. That means subsequently you cannot say that, sir, I would like to bring it to FETPL category. No, if you take that choice, it is irrevocable. Investment in debentures, then whatever it is reclassifiable only. And there is nothing like irrevocable due to change in assumptions. You can bring it to FET OCI, and after some time you feel that, okay, sir, I would like to take it to FET P&L category. Can I reclassify? Like your investment in accounting standard 13. Initially, my intention was to sell. Therefore, I show it as current investments. What? Now there is a change in intention. There is a change in intention. Can I reclassify to long term? Tell me, can we do this? Definitely. Initially, it was long term in nature. My objective was to hold it. There is a change in intention. Can I reclassify to current? Is that possible? Perfect. So, from current investment, whenever there is a change in intention, you can show it as long term. Similarly, from long term investment, whenever there is a change in intention, we can reclassify to current. So, instead of current, non current, all those things, here we say that, sir, I initially classified it as FET PL. Subsequently, can I take it to FET OCI? Yes. I initially showed it as FET PL. Can I take it to amortized cost? Yes. I initially showed it as amortized cost. Can I take it to FET PL? Yes. I initially showed it as amortized cost category. There is a change in intention. Can I take it to FET OCI category? Perfect. I initially show it as FET OCI category. Can I take it to FET PL? Perfect. I initially show it as FET OCI category. Can I reclassify to amortized cost? There are what? 6 possibilities, isn't it? Reclassification possibilities, isn't it? So if it is a debenture, then you initially show you can reclassify to whichever category you want. Can you get that? But if it is an investment, if it is a investment in shares, and at a initial recognition you took the choice of showing it under FET OCI. Now this is irrevocable. You cannot subsequently change it to FETPL. This is not possible. Can you hear that? Obviously, the question of amortized cost never comes into picture. Why? There are no contractual or identified cash flows. So that question is out of scope. So you cannot reclassify. That is the irrevocable choice that we are referring to. Clear? Okay. Then we had that FCTR, one another example for item that can be reclassified as foreign operation when we translate to Indian currency. It initially comes to foreign currency translation reserve, which is foreign currency translation. This is reclassified. Whenever you subsequently sell that particular foreign operation, you dispose that foreign branch, then it will can be taken to P&L. It is reclassifiable. Okay. There are certain other items that will come during the course of discussion when we come to Ind AS, respective Ind AS. We will come across more items with respect to other comprehensive income, whether it is reclassifiable or whether it is non-reclassifiable. Now, I am taking a passing reference of few examples so that you have a basic idea of these terminologies. Okay. Now, we took two examples. Actually, one example, I just customized the example and I have shown it how it has to be presented if it is non-reclassifiable and if it is reclassifiable. Okay. Now, we will come to next case. Okay, read. X Limited gives you the following information. Okay, what is the information? Stop. Invested in shares of. So obviously this is an asset, isn't it? To be specific, this is a financial asset. Sir, who says Ind AS 10 or Ind AS 32? In Ind AS 32, the definition of financial asset includes shares of some other company. Shares of. It is a financial asset. Okay. Now, read. So they say that they are going to classify it as FETPL. So when the asset is bought, though you have paid one money, it will be recognized at fair value. Any difference will be routed through P&L. Clear? Next. Mm. 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 Okay. So the story is like this. First April 2021, purchased for rupees 10 lakh. Year end 1, fair value 12 lakh. Year end 2, fair value 15 lakh. And during the year sold, selling price 16 lakh. So what is the journal entry? Investment account debit to cash or bank 10 lakh. At the end of year 1, tell me, sir, is there an increase in value of asset or decrease in value of asset? So is that a gain or loss? So asset will have to be increased. That means you have to debit investment by what amount? And the difference will go to P and L, isn't it? Now in balance sheet, the value of asset is how much? The next year, asset further value increases to what figures? So it increased by what amount? So what is the journal entry? Hmm. Now in balance sheet, what is the value of asset? Subsequently, the asset is sold. What is the journal entry? Bank 16 lakh, 15 lakh book value. Everything is routed through P and L only. There is no other comprehensive income. There is no other comprehensive income. Is that okay? Now, see, year 1, statement of P and L. Inside revenue, you have other income, fair value change, investment in equity classified at fair value 2 lakh, 3 lakh, and 1 lakh. There are no other impact. So, PAT 2 lakh, 3 lakh, and 1 lakh. There is no other comprehensive income. So, total comprehensive income 2 lakh, 3 lakh, and 1 lakh. And in our statement of changes in equity, each year, whatever is that PAT will come to your retained earnings. Okay, comfortable? If anyone wants to write how a FETPL category will be presented in this example, you can take it down. Once you guys are comfortable, message me so that we can push forward. Have you written the facts? Statement of profit and loss. Take down only the relevant items. Okay. What is this recycling adjustment? Can you tell me, Aradi, what is this recycling adjustment? So from the second room, something which you are taking to first room, isn't it? That reclassification, if there is anything, but in this question it is not there. In the previous question it was there. So from the second room we will reduce, and in the first room we will be adding, and we call it as recycling or reclassification adjustment. Clear? What is total comprehensive income, TCI? Total comprehensive income is nothing but your PRL plus OCI put together. Part 1 and part 2 put together is total comprehensive income. Clear? Total comprehensive income. That means whatever is your PAT plus whatever is your unrealized profits. Reclassifiable, non-reclassifiable, everything put together. Part 1 and part 2 put together is known as total comprehensive income. What is statement of changes in equity? It is nothing but a reconciliation. It is nothing but, see, we have cash account. It starts with an opening balance. All those items that increases cash will be debited. All those items that decreases cash will be credited. And finally, you will end up with closing balance, isn't it? So exactly, all items of equity, they're giving a reconciliation. What is opening balance? What are the positive changes that happened? What are the negative changes that happened? So that what is the closing balance? That reconciliation has to be given. Even now we do that. We do that reconciliation for general reserve in our reserves and surplus. We show what is the movement in general reserve. We show what is the movement in retained earnings in AS itself, isn't it? But here they have given it as a name. What? Statement of changes in equity. Statement of changes in equity. That reconciliation between what is opening balance and closing balance. What all items have increased equity balance and what all items have decreased the equity. When I say equity, I don't say equity share capital. I say equity. Equity means what? Equity means it is equity share capital and all reserves and surplus. Is that point clear? Obviously, for share capital also you have this reconciliation. What is opening share capital? Is there any public issue? Is there any bonus issue? Is there any buyback? Plus minus, and what is the closing balance? And such disclosures you are already showing it in your AS balance sheet itself. So that is nothing new. SOCI is something new. Therefore, I wanted you to present SOCI, statement of changes in equity. Once it is over, please do update me. Is it over? Okay. How about others? Can you guys message me? Okay. So the basis of classification, investment in equity shares, we have already discussed. We said that since there are no contractual cash flows, the cash flow test will fail. Therefore, it can be classified only at a fair value, and that too, we generally classified at fair value through P&L. However, there is an irrevocable choice. If you want, you can show it as FET OCI, and in such case, it is non-reclassifiable in nature. Now, next example. Read. Hmm. Okay, so they've taken that choice. This is irrevocable, isn't it? Okay. Subsequently, the value of the asset increased by no, increased by 2 lakh, increased to 12 lakh, isn't it? So whenever there is a change, that 2 lakh, that gain should go to part 1 or part 2. Inside part 2, reclassifiable or non-reclassifiable? Non-reclassifiable. The next year also there is a gain. To what extent? That should also go to part 1 or part 2. 3 lakh. And the third year, they sold it for 16 lakh. So at the time of sale, when you compare book value and the sale value, there is 1 lakh rupees profit. Clear? That 1 lakh rupee profit will go to P&L at the time of sale. Or else we can do, we can take this thing also will go to OCI, and finally you can take it to what? From source itself, we'll be able to take it to retained earnings. So let's come to the theory note. What is the theory note? As per Ind AS 109, an entity can make a irrevocable choice of classifying an investment in equity shares FET OCI. In such case, it shall be treated as non-reclassifiable item. Okay. Now see how we are going to present. Even at the time of sale, that 1 lakh itself, we are still showing it. Any fair value change is being taken to part 2. So, but when we were discussing now, the same question we have already discussed under PPE. When I was discussing PPE, this 1 lakh I showed where? I showed it as profit on sale. Profit on sale. Do you remember? But if it is a investment in equity shares which is classified under OCI at the time of sale, that profit will also go to, other comprehensive income. So can you get the difference between the presentation? And finally, now I know that there are 3 figures. You can see that there is 2 lakh, 2 lakh plus 3 lakh, 5 lakh, and again 1 lakh. Now 6 lakh is there. Once, and we know it is realized, we have actually sold it. Now we will take it from OC and we will add it to retained earnings. Okay. So even at the time of sale, that 1 lakh will not go to P&L. It will be routed through OCI only. And after that, in SOCI, you take it from OCI and you add it to retained earnings. Can you guys confirm whether have you understood the difference between revaluation surplus, Ind AS 16? There also it was non-reclassifiable. Even though it was non-reclassifiable at the time of sale, any difference between carrying amount and the selling price, we take it to P&L. Now here at the time of sale, any difference again go to OCI, and after that we take it from uh, uh, SOCI and we added to retained earnings. So confirmation please. Have you guys understood the difference between revaluation surplus and this presentation? How about others? So take down this and I want you to highlight the difference as compared to example 1 and example 3. What is the difference? I want you to write a one liner. In Ind AS, in Ind AS 16, it is clearly said at time of sale, the difference between sale proceeds versus book value. The official term is carrying value. The difference will be recognized in P and L. That means in our context, part 1. But in our Ind AS 109, with respect to investment in equity shares classified under FET OCI, difference between sale proceeds versus carrying amount is recognized in OCI subsequently in OC. Whatever is your accumulated fair value gain or loss will be transferred to retained earnings and closed. Is it okay, Arati? This somewhere this note, write it clearly. That means this is a comparison between our example 3, FS3 and FS1. Both are OCI, non-reclassifiable, but there is a subtle difference on account of respective Ind AS. One is Ind AS 16, one is Ind AS 9. One is with respect to PPE, one is with respect to financial assets. So see, Susan completed. How about others? You should also present that. So see, I think that P and L abstract of statement of P and L, that also you have to present it. Okay. Question is exactly same. I don't think so. You have to write the question one more time because facts are exactly same: 10 lakh, 12 lakh, 15 lakh, 16 lakh, isn't it? Even from first question itself, it is exactly same only. 10 lakh, then it became 12 lakh, then it became 15 lakh, and finally sold for 16 lakh. So need not write the question. The only thing is that it is an investment in equity share. You have taken the irrevocable choice. So kindly complete your statement of P and L as well as statement of changes in equity. In statement of P and L, I think only in OCI there is a figures. In part 1, there are no figures altogether. So kindly make it fast. Once it is over, please update me so I can take the next question. So what is the status, Arati? Okay, take your time. How about others? Okay, now next. So can we go to the next question? Okay, read. Mm, mm. Very important. Investment invested in bonds. It is not equity shares. Okay. Next, FET. So it is a investment in bond. Okay. And FET with respect to debenture investment, it is reclassifiable item. It's a reclassifiable item, isn't it? Okay. And we know first year end it became 12 lakh. Next year, asset further value increased to 15 lakh, and subsequently it is sold for 16 lakh. So theory wise, there is a cash flow test, and it will obviously pass because this instrument has a designated cash flows at specified points of time. The next thing is your intention, that is business model. If your intention is to receive all the cash flows, then you have to show the asset under amortized cost category. Amortized cost. If it is an amortized cost, then you don't have the concept of fair value change, because tell me, only if there is an intention to sell, then we need to think about the profit or loss, isn't it? Think about the example that we took. Your father purchased that property say 10 15 years ago. There is a change in the price of the property. For him, there is no intention to sell. If there is no intention to sell, that means he is going to stay in the property as long as he is alive. So, should we think about any fair value gain or loss? So, if your intention is to receive all the cash flows, then your return is nothing but cash flows. Whatever interest you are getting, that is your return. You are not concerned with fair value. Therefore, you don't have the concept of fair value change. But if your intention is to sell, then you may have a fair value impact, and that can be either fair value through V&L or fair value through OCI. And if it is fair value through OCI, it is reclassifiable in nature. Okay. Here it is reclassifiable. Now, see what we have done. Now, this is similar to which case? This is similar to our PP revaluation. At the time of sale, whatever profit it has come to P&L. Similar to which case? Our example 1, isn't it? At the time of sale, whatever profit has gone to P&L, it has not gone to OCI. And it is reclassifiable. Therefore, you can see that in OCI, negative 5 lakh you have taken out, and you have added that 5 lakh where, as a reclassification adjustment, you have added that 5 lakh to part 1. Okay. So, this is similar to which case? The presentation is similar to our FS1. That means it is similar to our PPE revaluation uh, reserve, revaluation surplus, that modified example, isn't it? Modified case, where modified case only we said it is reclassifiable. Clear? So take down the presentation. If it is bond, investment in bond categorized under FET then this is the presentation. If you don't want to take the entire presentation, you can take it is similar to presentation FS1 modified. At the time of sale, it will go to P&L, and whatever is accumulated will be taken from part 2 and will be added to part 1. So write whatever notes is relevant. I'll just display. This presentation already we have taken yesterday itself in example 1 in FS1, which in the modified case. Okay, Susan completed. How about others? Lakshmi done. Okay. Anyone wants me to wait? Does anyone want me to wait? If you want, please message W. So no message, so I'm just proceeding. So here you can see that in the statement of changes in equity, I've written investment in debt, fair value through OCA, which is reclassifiable in nature. Which is reclassifiable in nature. Okay, Aradhi? What is that we have written? Hmm. What do I mean by that is accounting for investment in debentures classified under fair value through other comprehensive income. Not FATPL, FATOCA. Accounting will have to be done. Obviously, we have to always go for step one, identification of cash flows. We have to compute effective interest, and we should be preparing table also. Amortization table. That means this is something that we have done in the second class or third class, isn't it? But the problem is in the amortization table, you will have opening value, you will have a interest at the rate, effective interest rate, you have cash flows, and you will have closing value. Assume closing value comes to say 102. You won't show it at 102. Instead, you will be showing it fair value only. Say because initial recognition is at fair value, and you would have done interest is added, cash flow is subtracted. Therefore, this is your book value. But fair value is 105. So this difference is what we will be taking to other comprehensive income. Clear? So that means if I properly do the accounting each year against this instrument, there is an interest income that has to be recognized. So I haven't done anything of that sort. I've just said that okay, my value, that means actually my presentation is wrong, because I simply said that debenture was acquired. Debenture was acquired at what price? Debenture was acquired at 10 lakh. I haven't computed effective interest. I haven't prepared amortization table, and I simply say that at the end of book year also it is 10 lakh. Now this is my carrying amount. I'm comparing it with fair value 12 lakh, and I say there is a fair value gain. How much? If you ask me, sir, this is wrong, because if the opening value is 10 lakh, I should have done effective interest computation. I should have added one interest amount. I should have reduced the cash flow. I should have, because I would have received some cash flow. If it is a zero coupon bond, at least interest would have been added and closing balance would have to be identified. This closing balance should be compared with 12 lakh, and you should compute your fair value gain or loss, isn't it? So I haven't done it for simplicity purpose. For simplicity purpose, I'm saying, okay, let us assume that there is no effective interest rate and all. There is no such concept of effective interest rate. 10 lakh mean becomes 12 lakh. The gain is 2 lakh. Okay. But actual accounting, when we come to financial instruments in detail, we'll be doing. Can you all confirm, please? So this question is not a proper answer. There is a huge deviation from investment with respect to debentures. Okay. at amortized cost, there is a mistake in the presentation. We acknowledge the fact, but we are doing it only for the purpose of how to present that other comprehensive income, how that other comprehensive income is presented in statement of P&L as well as in statement of changes in equity. So do you get that broad objective? And I've highlighted also here, I've ignored interest computation, effective interest, amortization table, everything is ignored in detail. We'll be doing when we come to financial instruments. Can you give me your confirmation? Okay. So if you have understood, we'll come to the next category of questions. Read. Hmm. That means it is the last item in your part 1. Okay, next. DRR is debenture redemption fund, isn't it? Okay, now doubt has been raised. Ritik has raised a doubt, sir. Effective interest rate method we are doing at the time of amortized cost. Effective interest rate method you are doing at the time of amortized cost. True. Effective interest rate method also will be doing for the purpose of fair value through OCI with respect to debentures. With respect to debentures, because not for equity investments. Investment in equity share, there is no question of cash flow. So let me highlight this point one more time. In amortized cost, for sure, you have to do effective interest rate and you have to do the table. Is that clear, Ritik? In amortized cost method, for sure you have to compute effective interest rate and table. Now, fair value through P&L. Next, we have fair value through OCI. In fair value through P&L, there is no concept of effective interest rate. There is no concept of effective interest rate. Clear? But in a fair value through OCI, we have seen two types. With respect to investment in equity shares, investment in debentures. In equity shares, there is no concept of effective interest rate and table because there are no designated cash flows. But with respect to debentures, we will have to have effective interest rate. We will have to prepare a table. But the book value, whatever the balance sheet figure that you are going to show, you are not going to show the value as per table. You are going to compare that book value with your fair value, and the difference you are going to take it to other comprehensive income. Clear? That is what I said. The detailed example presentation we will be doing when we come to Ind AS 109 or financial instrument. For the time being, we have seen the table for amortized cost category. In few of the examples, we have seen it for amortized cost category. Okay. So coming back. Now my question is, Aradi, when you transfer to DRR, is that your expense or is that an appropriation? So appropriation, any appropriation, will it be there in your part 1, part 2 or SOCI? It will be only there in SOCI. Any appropriation will be there only in SOCI, isn't it? So from retained earnings, some amount is getting transferred to CRR. Okay, it is part of SOCI. Very good. So it will be there in SOCI. Next. That is again appropriation. From P&L, you are transferred into general reserve. So there is appropriation. This is an appropriation. Second appropriation. Next, it is not at all relevant. Proposed dividend need not be accounted. Proposed dividend need not be. So we can ignore this adjustment. Clear? Both in AS also and in AS, proposed dividend cannot be accounted. It is just a disclosure. It is just a disclosure in notes to account. So it is not there in part 1. It is not there in part 2. It is also not there in SOC. Is that point okay, everybody? So whenever dividend is proposed, it is just disclosed in notes to accounts. It is not debited or credited to any account. Clear? This is not for Ind AS alone. This is as good for in accounting standard also. This is the method presentation. Next. The opening balance of various reserves and surplus, that is nothing but the opening balance of SOCI. Various columns you will be having. So various columns, the opening balance is there. Share premium account is there. Share premium account is nothing but part of reserves and surplus. General reserve, reserves and surplus. DRR, reserves and surplus. This P&L is nothing but our retained earnings, isn't it? Okay. During the year, that means during the current year, 2021. 2021 is nothing but your current year. How do I say? Because balance sheet date is 31st March 2021. That is 1st April 22, 31st March 21. This is your current year. So during the current year, a final dividend declared and paid, maybe during AGM in the month of May. I don't know. May 2020. Declared and paid. Okay, it's an appropriation. Dividend paid is an appropriation, isn't it? Again, it will come to SOC, statement of changes in equity. Is that okay? So how do you present it in your schedule 3? Sir, we know that we have statement of profit and loss. Inside statement of profit and loss, we have revenue from operation. Any information given? Nothing. Other income. Any information given? Nothing. Reclassification, adjustment. Tell me, are the any information given? Nothing. So there is no information with respect to total revenue, isn't it? Income, whatever. Then we have what? Inside our expenses, raw material, consumption, no information given. Then we have purchase of stock in trade, no information given. Then we have a plus or minus, increase or decrease in stock, no information given. We have employee benefits, individually no information given. Then we have finance cost, no information given. We have amortization bar depreciation, no information given. We have other expenses, nothing given. We get total expense. If you compare A minus B, we get a profit before tax, nothing's given, tax not given. PAT is given. How much is PAT? They have given our PAT to be 200. PAT is given as 200. Okay. PAT is given as 200. Okay. Then, but statement of P&L is not over. We have other comprehensive income. Non-reclassifiable, reclassifiable, no such information given. Therefore, our total comprehensive income is what? 200. Over. So, our part 1, part 2 is over. Now, we have to come to which statement? We have to come to statement of changes in equity. So, how do you present a statement of changes in equity? So, this example is more thrust is given for which statement? Statement of changes in equity. We have particulars. Inside particulars, we have a heading that is reserves and surplus. Everything is reserves and surplus only. Inside reserves and surplus, there are few items. What items? Share premium account is there. DRR is there. General reserve. We have retained earnings. Assume you had OCI items. OCI items like revaluation surplus, fair value through OCI, debt instrument, fair value through OCI, equity shares, investment in equity shares. And finally, we will be having total. Okay. Now tell me, what is the opening balance given? The question says that opening balance in share premium account is 100. Very good. DRR, opening balance is 200. Okay. General reserve opening balance is 980. And P&L opening balance is 10. No information given for revaluation reserve, fair value through OCI, debt instrument, fair value through OCI, equity instrument. Therefore, what is the total balance? Can you tell me what is the total balance? 100 plus 200 plus 980 plus 10. How much? Okay. Then what should I do? I have to add total comprehensive income. Now you tell me in total comprehensive income there is only one item, our PAT. PAT will come to which column? Can you tell me? PAT will come to which column? Only in retained earnings. What is our PAT? 200, isn't it? So 200 outer column. Now we have all other appropriations. What are the appropriation? Transfer to, I'm calling plus or minus. Transfer to DRR. Why do I call plus or minus? Because in retained earnings, 50 will reduce and in DRR 50 will increase. Clear? Outer column, there is no impact, nil impact, because it is a internal movement that has happened between components of equity, isn't it? Between equity, various components, one item decreased, one item increased. There is no impact altogether to the final solution. Next, transfer to general reserve. So plus or minus, transfer to general reserve. How much? 100 crore. So retained earnings 100 minus, and in general reserve 100 add. Nil. Proposed dividend not required. And there is minus dividend paid. Dividend paid, final dividend. It is not proposed dividend, a final dividend. How much is paid? 5 crore. There is no plus or minus because journal entry is retained earnings to cash. So cash account is there in the other side of balance sheet. So there is only minus. How much? 5. So dash 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 negative 5. Okay, over. So what is my closing balance? Help me. Give me what is the closing balance. Securities share reserve premium. Securities premium is how much? 100. DRR how much? General reserve P and L, I think we have to do 10 plus 210 minus 50 minus 100 minus 5. How much? 150, 55, 55, isn't it? From 200, if you reduce 100, it becomes 100. Again, 50, if you reduce, it becomes 50. 50, if you add 10, 60, 60 minus 5, 55. All these items, no information was there. In the previous question, if these items were there, we would have added revaluation reserve, all those things we would have shown. In this question, nothing. What is the total column? 1290 plus 200. No, 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 minus 5. 1485. This is how you prepare. Statement of changes in equity. Okay. If you want to see the printed answer, read out opening balance, share premium, DRR, GR, retained earnings, and actually there is nothing like other comprehensive income heading and all is not there. Okay. Presentation is the entire item is what? Revaluation surplus. The entire item is what? Reserves and surplus. Okay. So the entire heading is reserves and surplus. Inside reserves and surplus, you have got various items. Even all other comprehensive income is also part of reserves and surplus. Do you get that? But to give you idea, I have written it as two separate parts. One is reserves and surplus, one part, another part is OCI part. Okay. When you present the answer, because now there has been an amendment to schedule 3, they don't show it as OCI separately. This heading is not there. This reserves and surplus is extending to the entire presentation. Okay. But I'm keeping that OCI so that you can demarcate, sir, normal items. These are the new items that we are exclusively learning for CA final. Other items was there in intermediate. So these few items are exclusively there for CA final. So heading is fully known as reserves and surplus. See, like what I have written in my answer. The heading is fully known as what? Inside reserves and surplus, various components you have. Subheadings. Okay. Out of that, few items are pertaining to OCI. Out of the item, few items are normal items, which you have already seen before. Clear? Please do take it down. And in notes to accounts, what we have written? We have written proposed dividend. Current year proposed dividend will be there in notes to accounts. It won't be accounted. It will be just disclosed. I don't think so. You have to write the question. Just give the question reference FS5 and take down the answer. Sir, can we get such questions in examination? No, absolutely not. You don't get such questions in examination as to just to prepare SOCI. These are not at all exam representative questions. These are small example questions that I'm giving so that you are comfortable with the format. Okay. SOCI and all will be there as part of a full-fledged question. It could be there. But you don't get such questions for 2 mark or 3 mark. This is just given, taken so that you have a first-hand ideas about how to present all those things. So once I come to schedule 3, once I read through the presentation, everything will seem okay, sir. At least I know a vague idea of how it has to be done. So nothing seems to be new to you guys. For that purpose alone, we have taken all these small unrepresentative questions. What others? Should I wait or can we proceed? Should I wait or can we proceed? Now, first of all, tell me, sir, is the speed comfortable with you guys? Or am I going too fast? Or am I going too slow? Or I'm going at the apt speed? What are your thoughts? I want everyone's response. What are your thoughts? Are we going too fast? Are we going too slow? Or are we going at the normal speed? Okay. Yes. Okay. That I've asked them. There is some problem. I have asked this technical team. They say that the size is more than what is that the server can support. I don't know what they have trying to break it into different parts and upload. Okay. There was some error. One, if I'm not wrong, they said that initially it was uploading. They were able to view those files, but after that, sometime some kind of an error message they are showing. So maybe due to the size factor. So what they've said is they will break that into, say, assume if it is a 300-page document, they will break it into say 50-60 pages, separate documents, and upload it as part 1, part 2, part 3. Okay. Or chapter wise, maybe we should be able to upload chapter wise. Now it is a one full module I've given. Clear? So I don't know what is the error. I've asked them to check into it and rectify it. But for the time being, at least the previous question, everything we have written. That is asset acquired at 100, 10 lakh, then it became 12 lakh, then it became 15 lakh, and then it became 16 lakh. All the questions were the same manner questions. So that way there is no problem. In this question also, when once you look into the answer, you will understand what the question is. Opening balances are given, PAT is given. We have added to TCI, considers TCI, and all other either transfers are given. Clear? So for the timing, it is not a big deal. And answer anyhow you are writing in your notebook. So for the timing, it is not very difficult. So before we start with the official main topic, the module will be hard copy will be available at your end. Clear? So coming to next question. FS6. Read. Hmm. Hmm. Not accounted. So these items, the below mentioned items are not there in P and L, isn't it? It is not accounted. So assume that if there is an item that has to impact your part 1, then you have to consider that also. Therefore, your PAT will get revised. PAT will get revised. Clear? Now you tell me first item. What is first item? Revaluation surplus. Will it impact your PAT? So it will go to part 2 alone. So this will go to part 2. Okay. Next. What is the next item? Part 1 or part 2? So it will also go to part 2. So that means PAT, there is no change. So far PAT is 200. Next. Tell me, part 1 or part 2? So this will go to part 1. So if it goes to part 1, it's a gain, fair value appreciation gain. So our PAT will get revised, isn't it? The PAT will get revised to 220. Okay. Next. Part 1 or part 2? Okay. So we'll be able to get our TCI, total comprehensive income. Part 1 plus part 2, if you put together, you will get a TCI. And what is the next story? Similar to, I think it is the same part, the same question itself. DRR, GRR, all those things are similar. Opening balance 100, 980, 200, 10. Okay, I've just given two new items. New items because I've written few figures. So there are two new items. Otherwise, it is exactly same, isn't it? So tell me, what is the impact into my presentation statement of P and L? Statement of P and L. What will happen in my statement of P and L? Inside other income, I'm having that fair value change. Fair value change, isn't it? In my fair value change, I have one item. What is that? 20 crore. So there is a new item. Because of this new item, my PAT, I'm not writing all other figures. My PAT becomes how much? 220. PAT becomes how much? And OCI, I have non-reclassifiable. What is that? Revaluation plus. How much is revaluation surplus? 25. Again, I have, okay, fair value investment in equity shares, fair value through OCA. How much? 30. And investment in debt instrument, fair value through OCA, which is reclassifiable. How much? 10. So if I do this, everything put together, what is my total comprehensive income? 220 plus 25 plus 30 plus 10. How much? 285. 285. So here revaluation surplus, the balance is nil. No balance is there. Fair value through OCI. Fair value through OCI. That instrument they have given the balance. The balance they have given it as 15. Fair value through OCI debt instrument they have given the balance 5. So what will be my closing balance? 1290. Initially I got the figure. Last question to this I have to add 15. I have to add 5. What will be my opening balance? Perfect. Total comprehensive income. In total comprehensive income, where all there will be a change in my TCI, my PAT is equal to how much? I'm writing. So PAT 220 will come to retained earnings, isn't it? 25 revaluation will go to revaluation surplus. Investment in equity shares 30. So that will go here. Debt instrument 10, that will go here. So what is my total? 285. 285. Okay. Transfer to DRR, exactly, there is no change. Transfer to general reserve, there is no change. Dividend paid, is the dividend paid 5? So that is, there is no change. If that being the case, securities premium, answer is final. DRR, answer is final. General reserve, answer is final. In P&L, there is a change to the answer. So 10 plus 220 minus 50 minus 100 minus 5. Answer is 70. Revaluation reserve, answer is 25. This answer is 25. This answer is 35. So what is the final answer? 1310 plus 285 minus 5 is equal to, sorry, 90. True. 1590. Clear? Is that okay? So the only thing is that I had few items. I had one item in PAT. Part 1, I had PAT 220. For the 220, one new item was there. That fair value change not yet accounted. So that alone I've shown inside other income. And I've directly shown my PAT to be 220. And OCI, there were 3 items in OCI that I've represented. I got TCI. Total comprehensive income is taken to respective column in SOCI against each item. Then I've done the presentation. Final answer is 1590. So let's see the printed answer. So in the printed answer, I haven't shown P and L. I've directly presented what? SOCI. Okay, here I think I've updated the presentation. I've taken the total heading to be what? Reserves and surplus. But for your clarity, I've kept this particular item OCI heading so that you are comfortable. The new items that you are learning in CA final. So 1590 is perfectly pairing. So take it down. So why did I take this thing with red color? Why it is red color is not copied and pasted. There was a change. The change has been incorporated. Clear? So when I take with a figure, once I think that is a color code. If I take a figure to be in red color, that means it is not copied from the question. We have done some kind of a interpretation to it. Now why I've added that 20 rupees not accounted. That is why it becomes 220. Clear? So take down the presentation. How about others? So Sri Rashmi completed. Rifana completed. Others? Okay, done. Now, now we are going to learn a new concept. So far, we have basically understood, sir, the presentation which is there in P and L, almost revenue, what all headings in statement of P and L. Part one, what all items are there? You have income, inside that you have revenue from operation, you have other income, then you have expenses. Inside expenses, what are the different headings? Da? Consumption of raw materials, then we have a purchase of stock in trade, then you have a plus or minus increase or decrease in stock, we have employee benefit expense, we have finance expense, we have amortization, depreciation, and finally we have other expense. Is that clear? So, and after profit or loss, P or L, that is part one, we have part two, that is other comprehensive income. Out of that, we have two subheadings: items that can be reclassified, items that cannot be reclassified. Inside items that can be reclassified, we understood that fair value through OCI with respect to debt instruments, as well as FCTR. Items that cannot be reclassified, we understood revaluation surplus, as well as fair value through OCI with respect to investment in equity shares of other entity. Investment in equity shares of other entity. Is that okay? After that, we've come to statement of changes in equity. We saw that there are particulars, there are lots of reserves and surplus. Out of normal items are there, and these new items are there. Everything has to be given separate columns, separate columns, and we have to give a opening balance, the plus and minus that is happening during the year, and what is the closing balance. The reconciliation has to be given. Clear? So this is what we have learned. Now we are coming to inside Ind AS 1. Treatment of errors as well as treatment of changes in accounting policy. Okay. In Ind AS 1, we are going to discuss treatment of errors as well as treatment of changes in accounting policy. Okay. So first we'll come to treatment of errors. Okay. See, already we have learned in AS, in accounting standard 5, this has been discussed in detail. It is known as prior period items. What? Assume that this year, assume that you are going for audit. You are going for audit. Say the current year is 21-22. The present audit that is you guys are actually going for 21-22. You are doing the audit and you observe that there is a expense. Current year expenses, say 100 lakhs. Also, you observed that there was an expense for the year 2021, but last year you showed it as 95 lakh. But in fact, there was an accounting mistake. Actually, it was only 85 lakh. So what will you do? When you identify there is a mistake in the last year, when you identify there was a mistake, there is an expense, it should have been only 85, but unknowingly at the time of passing the journal entry, you unknowingly typed it as 95. So is there a mistake? Now what is the remedy that you have in accounting standard? As per accounting standard 5, what do? If you identify a mistake pertaining to the previous year in the current year, it is known as prior period item. What are prior period items? Prior period items are nothing but mistakes in the financial statement of the last year identified in the current year. The current year I have done a mistake, then the accounts is not finalized. Now it is 100, you understand it is 85. Very well, you can pass journal entry and make it 85. There is no mistake because accounts are not finalized. Accounts are not finalized. You identify it, you change the figures and you update it. It is over. But now the problem is last year you have already finalized it. It is already printed. It is already attested by the chartered accountant. Now what do you do? In current year P&L, you show is that as a prior period item. You show it as a prior period item. Now you tell me, what do you want? You want the profit to increase or decrease? Because of this particular mistake, you want the profit. Now you have shown 95. It should be only 85. So you want profit to increase, isn't it? So it is a basically you want to increase your profit. So prior period item, you will show a prior period item and you want, I'm just writing profit. I want my profit to increase by 10 rupees, isn't it? Okay. Sir, what is the remedy that you have in Ind AS? What is the remedy that you have in Ind AS? Now, in accounting standard is very particular. You cannot change these previous year figures. Attested figures cannot be changed. Or last year profit, assume that last year profit you had 120 lakhs. This is already attested. This PAT is already attested, verified. You cannot change these figures to. You say that, okay, so not so 120, it should be 130 lakh. You cannot update it. If you want, you have to update in current year profits, isn't it? That is what we have to do. Tell me, sir, everybody, is that you do? You cannot revise the figures of the last balance sheet or P&L. Whatever last year figures, let it be last year figures. You have identified a mistake, bring it to current year and give the disclosure prior period item. And give the disclosure prior period item. Last year income, last year expense. It should be more, it should be less. And you update current year's profit, isn't it? You increase or decrease current year's profit. You never update the previous year's profit. Tell me, am I right or wrong? This is something that you have already learned in accounting standards in your group 2. Group 2, intermediate. Now, what does Ind AS say? No? Ind AS say there is no such concept of prior period item. This year you observed, you have identified a mistake. No. What you have to do at the time of audit, don't copy paste 95, make it 85 and update the answer to 130. Update the answer to 130. Do you get that? If there is an error which is identified in the current year pertaining to the last year, you are not going to show that expense in the current year balance sheet or P&L. You're going to take it to previous year figures. Comparative figure itself you will update. You will update it and you will update previous year profit. You will update previous year profit. So have you understood this? There is a difference between AS as well as Ind AS. Ind AS, if there you find a mistake in the last year, update last year figures. Don't bring it to current year as a prior period item. Okay. Update previous year figures. Update previous year profit. Now the question is, sir, the mistake is not pertaining to 2021. Assume I identified a mistake pertaining to 18-19. The mistake was pertaining to 18-19. Now, sir, in my P&L, I am not showing the 18-19 P&L comparative figures. I only show current year as well as. We only show current year as well as previous year. Isn't it? Respond. We only show current year as well as previous year. Now, this is 18-19. What should I do? They say that if there is a mistake pertaining to a year prior to your previous year or prior to the comparative year that you have represented, then you are required to prepare a third balance sheet, third balance sheet, and a third balance sheet, a revised balance sheet as on beginning of previous year, beginning of previous year. So can you tell me, Aradi, what is the beginning of the previous year in this question? What is the beginning of previous? What is the current year? Give me what is the current year in this question. What is the previous year in this question? So generally, when we prepare a balance sheet, how many balance sheet do you prepare? Balance sheet as on 31st March 22. This is current year. Previous year, what? As on 31st March. If you identify a mistake pertaining to the last year, then you're going to update. If I identify a mistake pertaining to the last year, then you are going to update in the respective columns, isn't it? Rows. But if you identify a mistake which is pertaining to not last year, some other prior years, then you are supposed to prepare one additional balance sheet. This balance sheet as on, can you tell me? 2020, beginning of the previous year. Balance sheet as on beginning of the previous year. Is that okay? In this balance sheet, I'm going to update the figures because the balance sheet opening balance, if the profit is going to get updated, 1 second. If I change my P and L of the respective year, then in my retained earnings, old figures will get updated due to mistake in 1819. This figure is going to get updated, isn't it? A new figure I'm going to present. Clear? Okay. So what is Ind AS saying? If you identify a mistake pertaining to last year, should you bring it to current year as prior period item or update in previous year balance sheet P and L itself? What is that Ind AS saying? Update respective item where the mistake is updated. Pass the journal entry in last year financial statements and update it. Make it correct. Disclose that there is a mistake in financial statements. Don't bring it to current year. Current year only items pertaining to current year, bring it to current year. Last year items and all, you should have done it last year itself. Update in the respective financial statement. But the mistake is not pertaining to the last year. It is pertaining to some other old years. But it has to be broad. But you are not preparing all the years balance sheet. No, you are not preparing 10 years balance sheet. When you prepare a financial statement, you are not giving 10-year comparative data. You generally give only 1-year comparative data. So if there is a mistake pertaining to old year, then they say that prepare one additional balance sheet as at the beginning of previous year, and whatever mistakes update it, and from there you present all the correct figures. Clear? Have you understood? Is that point clear? How about others? So there is a concept of third balance sheet. There is a concept of third balance sheet for mistakes pertaining to some old years. Mistakes pertaining to current year, there is no concept itself because anyhow you are going to rectify it in the current year itself. Mistake pertaining to previous year in the respective previous year column. Mistakes pertaining to some other old year, then a third balance sheet concept. So this is given in which standard? We'll come to it. We'll come. Ritik, what will be the journal entry? Think about it. You want to bring an outstanding. Tell me, Ritik, you want to bring an expense. What will be the journal entry? Tell me. You want to bring a change to your expense. What is the journal entry? You are not going to prepare a third year P&L. So you will take it to retained earnings. Retained earnings will be debited. And if cash was already paid, then cash will be credited. So cash is updated. Expense will come to P and L. If expense comes to P and L, your retained earnings is going to reduce. No, sir, the cash is not paid. Then outstanding salary, retained earnings to outstanding salary. Is that okay? You are not going to show entry as salary account debit to, because you are not preparing that last 2018-19 P and L. You are not preparing to bring it to salary account. So you will just update in retained earnings. You will reduce retained earnings. Profit will reduce to that extent, isn't it, Ritik? So whichever, I don't know, journal entry will have debit and credit. If it has any impact to your P and L, it will adjust in retained earnings. And respective assets and liability will come to balance sheet. I don't know. Depending upon what the transaction is, we have examples. We'll go through that. Similarly, another item is changes in accounting policy. How should you go about with changes in accounting policy? So all those items we'll be able to take tomorrow. Clear? So basic one reference is being given as to if there are errors in AS, you show it as prior period item. In Ind AS, there is no question of prior period item. There is no question of prior period item. You cannot show under prior period items. Errors pertaining to the previous year against respective item of the last year is comparative data itself updated. Pertaining to some old year, prepare a new balance sheet, third balance sheet. Okay. So have you all understood today's discussion? Are you guys comfortable with today's class? How about others? So bye bye. Take care. Good day. Okay. Da.